Hello, Tigers. Good evening. Welcome to tonight's live session. Our topic for tonight is bubble or trouble, hunting for value in the US stock market. This is Esther from Tiger Community, supporting from Beijing office. Tonight, we are very honored to have two guests here, James Early and Owen Chasey. Both of them have over 25 years experience in the US stock market. Let's welcome James and Owen. Hi, James. Can you introduce a little bit about yourself?
Hi, Esther. It is really great to see you. And those watching may not know we've known each other for probably 11 or 12 years now. So it's great to be on air talking to the Tiger Brokers customers in Singapore. I've been investing for about 25 years, a little bit more as a professional investor, both in the US and in Asia. I spent about 10 years of my life, a little more than that, doing business with Asia in different capacities. But so I'm happy to be speaking to a Singaporean audience tonight.
Thank you for accepting our invitation and bringing Owen here with us also. Hi, Owen. Thank you for getting up so
Hi, Esther. How
early
are you?
since you are in West US. Could you introduce yourself to our audience also? Thank you.
Well, it's a pleasure. I'm a global strategist and with a particular focus on just cross asset allocation. So, really, I've been traveling the world to teaching people, talking about how to invest in markets for over 25 years. Mostly what I do is strategy and really trying to look to the future and to be early in order to really take advantage of the greatest and the biggest trends. But also with a particular focus on technology and how it interacts with different parts of the global market in conjunction with the commodities. Because the commodities are, I think, very topical right now, and I think this is a very important time to be thinking about it.
Yeah, that's right. Because okay, let me mention again. James Early is the CEO of Curio Financial, and Owen Chasey is the CEO of Follow Chasing Money. So as we've all seen, the US stock market has fallen for 3 consecutive weeks, and there's a lot of honey in the balance right now, as Owen mentioned, the upcoming Fed's rate decision, NVIDIA's big GTC conference this week, and also last week, the US GDP data was weaker than expected. And also the geopolitical tensions are still simmering the crude oil and gold assets. And currently, the taco and the halo are really hot topics among investors. So we are really at a bubble trouble crossroads where geopolitical risk and the AI revolution and the sector rotates. So I'm really glad that James and Owen are here to break all this down for us today. They will cover the Iran conflict, the halo versus SaaS valuation gap, and the emerging markets. So Tigers, please stay focused on today's live. James also prepared 3 questions for you guys. The first person to answer each will get some Tiger Brokers merchandise. So back to James and Owen. Thank you.
Thanks, Esther. And I wish I could be in the audience because I'd like some Tiger merchandise too. That sounds pretty cool. So if you don't mind, I'll just start sharing the screen and share our presentation. We go into it. We call it bubble trouble. We have a bubble. I don't know how much trouble we have yet, but we have bubble and potential trouble. So here we go. I'm going to share this and make it full size. Hopefully this is working for everybody watching at home. So just a reiteration of who we are. We both are in the investment research business in some capacity. As a fun fact, we are just a couple of months apart. Owen and I are basically the same age. He's authored a book. I haven't, but we both worked together in the UK, and that's how and where we met. All right. So in this 30 or so minutes of talking, followed by your questions, we'll cover a few things: the Iran conflict and a general macro review, Halo, the heavy asset, low obsolescence, kind of the bricks and mortars company versus SaaS. Is Halo in a bubble and is SaaS too cheap? We'll talk about that. Emerging markets are down after a year and a half of beating the S&P 500, and we'll talk about a few stocks we're watching, and we'll take your questions. I should kind of blanket this by saying we're going to mostly focus on the American stock market. I think that's what a lot of people who have Tiger accounts are investing in. But both of us can talk to some degree about international markets. Owen, a lot more in a lot more granular terms than I can. Owen's got a lot better points than I have generally. That's why I got to make up for it with fancy lighting. But I think we'll both try to add value for you guys. So the first question, these are the preface questions that we'll answer at the end. If you pay attention now, this is how you get the Tiger merchandise. I don't know what kind of merchandise, but I'm sure it's good. First is, what anti-drone US stock am I interested in? Okay, keep watching. You'll find the answer to that. It won't be too hard. Second question, what percentage of US stocks have contributed all the market's returns over the past roughly 100 years? And the third question, what type of oil is most connected to Owen's ending investment thesis? Something he'll mention near the end. Is it crude oil? Is it baby oil? Is it something else? We'll talk about that as we do this. Disclaimer, legalese, we're not giving investment advice, definitely not personal investment advice. This is for educational purposes only. Our thoughts are our thoughts. They may or they may not be Tiger Broker's thoughts. So just take it all with that in mind. All right. I like to set the stage increasingly when I give talks by showing a couple of numbers to put investing into perspective. In fact, I could almost give a whole live stream about these numbers. This shows you how hard it is to beat the market. Not impossible, but it's hard. Hank Bessenbinder, a professor at Arizona State University, found that from 1925 to the end of 2023, so almost 100 years, just 3.2% of US stocks contributed all the gains. It's a lot more like venture capital investing than you might think. 60% of stocks lost money, and 40% actually went to zero over a 20-year period. I think it's JP Morgan Asset Management who found this stat. 94% of large cap investors over a rolling 20-year period can't beat the S&P 500, yet you're paying their management fees. It's a social science. So that's how hard it is to pick stocks. Now let's talk about time periods. If you had missed the best 1.9% of trading days over the past 20 years, your returns would be 93% lower. Conversely, if you'd missed the worst 1.9% of trading days, your returns would be a little more than 2,000% higher. So this all comes together to paint the picture of investing being a sport or an art where a small number of stocks over a small number of time periods deliver substantially all the returns and losses. In other words, as Jack Bogle, founder of Vanguard, said, if you can't find the needle in the haystack, you might as well just buy the haystack. So there's nothing wrong with buying a boring index fund and waiting, or at least there's not much wrong. Sometimes that could be critiqued if it's a cap weighted and the market caps are skewing things. But generally speaking, you're okay, especially if you're a new investor, to buy an index fund, at least in my view. So with that preface, let's talk about some current events. I'm just going to go through this. Oh, and feel free to jump in anytime you want. Again, what you have to say is usually a little sharper than what I have to say, but I'll lay the groundwork here. So the Iran war, I put war in quotes because it's a conflict. Congress is who declares wars, and this was obviously not run by Congress. 47% chance, according to Polymarket, that it ends by the end of May. Trump, I don't know if you guys can read this quote, especially if you're watching on a mobile. He said March 11th in a speech in Kentucky, "You never like to say too early you won, but we won. In the first hour, it was over." Well, Polymarket doesn't seem to agree. I have some stats here too, that the U.S. has effected 28 official regime changes, a lot more unofficially, official regime changes since 1900. Only 3 of those have led to lasting democracies. And 80%, according to an academic study, of regime changes lead to some kind of dictatorship. So the odds, to segue to the next question, at least I think, and Owen, I'm welcoming your thoughts on this. I think the conflict doesn't drag on. Trump has political reasons to end it, but it also likely doesn't result in any meaningful regime change. It might just embolden Iran to double down on their weapons, double down on hitting the West. We're not political
I think
analysts here.
actually it's probably I think the most likely scenario is that it is not going to end by the 31st of March,
Yeah.
but it will probably be over by the 31st of April. But that is going to create a 2-month hold in global supply of energy. And I think that there is one thing that we see in the market, and I think this is probably the best way to think about it, is that the stock market is steady because people think it will be over by March. And it will not be over until the stock market pulls back sharply. And in order for that to happen, people have to start to believe that it is going to last longer than the end of March. And when people believe that and they sell, and we get a sharp pullback in the stock market, well, then that is what will prompt the US government to change what they are doing. Because right now they feel like they have carte blanche, that they think that they can do whatever they want because the stock market's not really reacting. And in many respects, that is true. So what we really need is contrarian sentiment to evolve here. We need the stock market to send a signal that they're worried about inflation and they're worried about an economic downturn. And it's really only then that they will stop bombing and the Straits of Hormuz will open back up again.
So true. And Trump is a political animal, if nothing else. And if the stock market disapproves of something he's doing, it's hard to imagine him continuing to do that. And I just saw the front page of the Wall Street Journal today. America's allies are not particularly supportive of helping the USA in this conflict, at least the Straits of Hormuz, which would seem to be something they have a vested interest in. So, yeah, it's hard to see this dragging out for too terribly long. We got a question in the chat: why in? If Middle East tensions escalate, should we be adding more energy and defense exposure, or is that already priced in? We'll get to that in a second. Why in? It's always tricky to make a bet on politics because it's something that's inherently a decision in the hands of a few people, and that the outcome could hinge on someone's blood sugar a particular day, especially in this case. I think what we're saying though is neither Owen nor I would bet on a very prolonged war. I think that's unlikely. So, all right, returning to the script here. Uh, One man's inflation, if one man is paying higher prices for something, that mathematically means someone else is receiving those higher prices. It's a little more complicated when you're talking about inflation. It's not quite like accounts payable and accounts receivable in finance, but it's a little bit like that. In this case, this is from Prof G Markets. I just like this chart here. Norway is the big winner so far in the war. This is projected early today here in the U.S. change in GDP growth as a result of the war in Iran. Now, if it does become a prolonged war, and I got to put my glasses on to read this, this is numbers from Owen's recent report here. Recall that Middle East supplies 50% of global urea, 41% of sulfur, 30% of ammonia, and 10 to 15% of mono and diammonium phosphate fertilizers. Those are really important, not just as abstract things, but they affect the world's food supply. So this is a very important region geographically, and those high prices could ding a lot of countries a lot worse than perhaps people think right now if we have a prolonged conflict. A few mysteries that are maybe kind of not mysteries as we look a little deeper. Normally, the theory goes, when you have uncertain times, you have a flight to quality. U.S. Treasuries are one of those areas of quality, but investors have been leaving Treasuries. In other words, yields have gone up because money has gone out. Bonds pay fixed payments. And so when the prices go down, mathematically, the fraction works out so the yields go up. Why is that? Another mystery, gold, another traditional safe haven in uncertain times. Gold dropped precipitously since the conflict started. Well, the reason for these things is the US dollar is up. And when the dollar goes up, treasuries, gold, those things become more expensive in non-dollar terms because those non-dollar currencies have to be converted to dollars. In fact, there's a working paper, it's not a peer-reviewed paper yet, but from the National Bureau of Economic Research that basically says the same thing. Because of inflation, because wars create inflation, government bonds tend to actually be poor investments during actual times of war.
And of course, the other thing that the reason that this is happening like this, where you have the dollar up and you have treasury prices down, well, A lot of that has to do with the fact that the Fed can't cut interest rates with this kind of environment, that they're worried about inflation. And if they're not going to cut rates, they might actually be forced to raise rates. And if they raise rates, well, then that's bad for the 2-year yield. That is negative for gold, but it's positive for the dollar. So that is the that is the one thing that ties all three of those charts together. It means that
Yep.
the market believes they cannot cut. They might have to hike.
And with Trump, with presumed appointee Kevin Warsh coming in, who's basically telegraphed that he's on board to lower rates like Trump wants, even if he is or isn't in real life. There's been some expected rate cut priced into the market, so that may not be able to happen, Owen, as you're mentioning. So, uh, Avi Gut said,
There's one other thing that's
"Yep,
just worth considering is that every time there's a new Fed chair, so the last time was 2018, uh, you get the market having a mini crisis. People don't know what the new Fed chair is going to do, and they generally sell, or the market creates a mini crisis to present to the new Fed chair to see what he's going to do. Because what the market needs to know is that the new Fed chair will cut rates and increase liquidity in the event of a problem. And we're going to be presenting Kevin Warsh with quite a problem when he takes over in the middle of May. And that is going to be a big decision point for the market.
Kevin Warsh better have some good anti-anxiety medicine. He's really stepping into the frying pan in a way that most Fed chairs haven't. It's going to be a stress with his boss and just with the situation, especially if the conflict is still ongoing. Um, Abigut says no matter what, oil will even eventually come down. Indexes will go back up. This is typical Trump playbook since the first tariff was announced. Probably some truth to that. Abigut asks though, Owen, why is Bitcoin up since the war started?
I
Any
think the
thoughts on
main
that?
reason I think the main reason Bitcoin is up is that the one thing is that the price was back to the marginal cost of production. So
Hmm.
around that $60 level, it's going to be hard for Bitcoin to fall below that region. Then I think that the market is pricing in that Bitcoin is independent of government. And a lot of what is going on right now is very geopolitically minded. So Bitcoin is that partial hedge. And I think Bitcoin investors are looking at the possibility that the only way we get out of this problem is if central banks print money. And that is the primary reason why Bitcoin goes up. It is a liquidity barometer. If liquidity increases, then Bitcoin does well.
And that's why I mean, one might wonder why aren't Bitcoin and gold behaving in the same way? Is it liquidity?
Well, if you think about Bitcoin, that is, I think, more of a digital asset, and gold did exceptionally well in the early part of this year and late last year. So Bitcoin is cheap, and I think gold is still consolidating. So if you are looking at more of a value asset, Bitcoin is the asset if you're more thinking about a buy low, sell high kind of environment.
Abigut seems happy with what you're saying, Owen. He totally agrees. All right, so in positive news, this is from Charlie Bolello, who puts out some very good charts every week. Wars are good for the economy, at least the stock market in the USA historically. You can't say every single time it's going to happen, but if you look at the past, for those watching on a mobile or a smaller screen, basically this is a chart showing all the US wars since 1941, World War II, when we had a decent sized stock market, 6 months, 1 year, 3 year, 5 year, 10 year, 20 years after the start of that war. And even after 6 months, after the vast majority, I don't know what percent it is, maybe it's three quarters or more of the wars, the stock market was up after 1 year. Even a higher percent was up after 3 years, all except one case, the Kosovo War. That's because of the tech bubble. The market was up. So basically, the market has gone up after wars, and I think it's the same for pandemics as well, cataclysms and bad headline stuff. Cataclysm, whatever tends to be good for the stock market in the long run. It doesn't
The
totally
one
make
thing,
sense, but
look at that though, is that financial and military aid in Yom Kippur War in 1973 was down 14% in 6 months and 41% in 1 year. Well, that was the oil crisis.
yep.
So, that is the one counterfactual that we actually should pay attention to in this kind of
Because it's the
environment.
most akin to this environment now. Yeah.
Yep, absolutely.
Yep. Good point. Good point. All right. So what's going to happen, right? Again, caveat, I don't really recommend, especially new investors, to make big bets predicting politics, predicting a war. It's just too much of a binary thing. There are other safer, longer term ways to invest. But because we're talking about it, the positive case would be, hey, you've got the post-war rebound historically, which we just saw in the last chart. The USA has, or the world has a lot of oil. Most of the new capacity, I think 70% over the past 10 years of the new capacity coming on. Yeah, here it is right here. 70% of global capacity growth from 2008 to 2025 has been from US shale coming online. You've got disinflation of housing. You've got inflation optically, right? We do have rising prices, but housing prices, rents in the US are not that high and they're softening a bit. And that's most people's biggest expense. And that's looking better. And finally, you've got kind of this mushy factor called AI productivity. It just makes things cheaper, quicker, easier. This PowerPoint, our designer used AI to help accelerate it. Not entirely, but that's the kind of thing that would have taken 6 hours in the past and maybe took a few hours now. So AI accelerates productivity. There is, of course, a bear case, stagflation. Owen mentioned the oil shock of the 1970s. This is a gas line here in the USA from back then. The worst case is the war drags on. We don't bail after 3 or 4 months. Oil goes back up over 120, whatever. Soft corporate earnings, job losses, high interest rates, low liquidity. That's going to affect small companies in particular. Small companies are disproportionately borrowers compared to larger companies, and disproportionately borrowers at variable interest rates. And so when rates go up and when it's harder to borrow money, the small companies, which tend to be more domestically focused by their nature, tend to suffer more. That's definitely true here in the USA. I think it's true worldwide as well. So that's the bear case. Again, nobody knows. I think a bad bear case is unlikely here, but if we had one, if we had one, what might do well? Uh, Non-Middle Eastern oil companies, you can see right here, Exxon, ConocoPhillips, Apache, I think APA is their new name now. Commodities companies likely will do well. You could make a case for gold. Tankers like Frontline, tanker rates have gone up 10x, literally 10x year over year. It's like $500,000 a day to charter a tanker. 16 tankers I counted have been attacked by drones though since this conflict began. So there's risk that tankers are bearing. The weapons companies, missile defenses, marine companies, and one wild card, which I'll mention quickly, and this is where I got this photo of a guy holding a drone. This AeroVironment, AVAV is a ticker. Unlike most of these others are kind of obvious war plays. And for the most part, their stocks are up year to date, sometimes quite a bit. AVAV is down, $10 billion market cap, which is kind of like small mid cap ish. It makes drones and it makes lasers that shoot down drones, not yet being used in the Iran war, but potentially could be. I don't know enough about this company to say that I'm going to buy it. We're not here to make recommendations, so I'm not going to say you should buy it. It's something, though, that does interest me. It is something I do want to do more research on. Again, I don't know enough yet to say anything conclusively, but AVAV could be a value play, but it could also be a value trap. All right. So we've covered war stuff. Now let's get to more plebeian matters or US focused matters, at least. I added here, still in a liquidity driven market. What does that mean? Yeah, people have been talking about valuations of US stocks for a long time. Like, oh, we've got this frothy market. We've actually got kind of a K shaped market. I read they call it the Hindenburg risk or Hindenburg effect, where you've got uh, more stocks reaching new 52-week highs. At the same time, you have more stocks reaching new 52-week lows. So the winners are winning and the losers are losing more so than normal. What does that mean? That means risk. That means risk. I don't think anyone would argue otherwise. But in terms of this year, This is from a buddy of mine, Phil Rosen. Opening Bell Daily is his uh, daily research email. It's a very good email. Energy stocks, the big winners year to date so far, up 24%. The big losers, financials. With those rates rising, as Owen and I spoke about in a US live stream last week, that short end of the yield curve is coming up. Those 2 years are coming up. The flatter yield curve is not good for banks because they pay out on the low end and they receive on the high end. I don't know if my forearm is a good visual for this, but banks want a nice steep yield curve, and they're looking less like they're going to get it now. But you can see on the left side of the graph again, after energy staples, materials, industrials, utilities, those are kind of the brick and mortar nuts and bolts, heavy assets type companies. Meanwhile, tech is down, discretionary is down. So those tech was just richly priced before. And I have a little tiny graph on the side here. This is probably hard to read. Even for me, it's hard to read on a full screen. It just shows that large cap value stocks, IYD index up 7% year to date, and IWF, US large cap growth stocks, down 4.6%. So finally, after some time, value is beating growth. We've definitely had a hard rotation this year, which brings us to one of the topics we advertise us talking about here in this webinar: Halo stocks, heavy asset, low obsolescence, a term Josh Brown coined a couple of weeks ago. Look at this: Walmart, PE of 56. That's 58% above average, 10-year average. Costco, 52. 46 Walmart, 52 Costco, 41% above average. Eaton makes kind of electrical pieces and components, 34 PE, that's 48% above average. Caterpillar, 37 PE, which is 95% above its average. For context, NVIDIA has a PE of 36. Owen, what would you say to this? Am I missing the missing variable here is growth. Okay, some of these companies have vastly different growth numbers, and that's not reflected in a PE. Although supposedly, if you're buying because of PE, you should be looking at growth. Do you have any comments on this?
I think Walmart's an interesting one because it's sort of a very defensive stock, but also heavily embracing technology. So there's an AI twist on Walmart and I think one of the things that they've done is they've really promoted their website. So they're getting people that would never normally go to a Walmart actually shop online. And they have a service that they will come to your house and they'll put away your groceries for you. So there are definitely aspects to
That service
Walmart
to the
that
point of
are
being
attractive.
invasive. They come into
Well,
your
if
house and
you
put your
volunteer for it, or you're in
yeah,
a
yeah, if you
wheelchair,
want it, yeah,
or you're elderly,
yeah, yeah.
you probably don't want to go to the supermarket. So, that's a kind of an attractive thing from a lot of people's perspectives. And I would say that it is adequately priced in at a PE of 46. That these are incremental potential gains. I think Walmart is kind of expensive at this level. And the reason that Costco has gone up is really because people are betting maybe that they're going to get some of the money back, that they're going to get a refund with tariff refunds from the government. So there's just a kind of a one-hit bump to their price. But both Eaton and Caterpillar are now AI stocks. Now, you might argue whether they're actually anything to do with AI, but they are benefiting from the massive amount of money going into building data centers. And they're being traded on that basis. And I think that's really why the PE is high. But again, these are really heavily dependent on that AI spending lasting indefinitely. And at least for the moment, that does look to be the case.
Would you say? Oh, and by the way, to frame all this, Costco is one of the companies suing the U.S. government for tariffs. I would be surprised if the average Costco customer, I'd be shocked if they get a tariff refund in any capacity. It's just a real mess to sort out. But interesting. So it sounds like, Owen, do you think Halo? I mean, just it's a mushy term. It's not clear exactly which stocks are Halo stocks and which are not. But Halo formed kind of as a result of people fleeing this AI bubble because, again, we have a liquidity driven market. There's a lot of money sloshing around. It was in NVIDIA, which was 90 times sales, not only sales about a year ago or a year and something ago. Has that money just merged into Halo stocks instead? I mean, writ large, would you be buying a Halo ETF right now?
Well, I don't think I would buy a Halo ETF now. I think a lot of this was panic about the sell-off in software, and everyone was wondering, "Oh, well, I can't buy anything that's going to be affected by artificial intelligence, so I'm going to buy a supermarket." And okay, that makes sense if you're in a panic, but I really think it's too late. I think if you really want to own these, high sort of footprint, very secure companies with attractive dividend growth and dividend yields, you have to buy them after a pullback. You do not chase them on momentum.
Got it. And we got some questions. I'm going to read them in a second, but let me first ask Owen, would you, if you could have Walmart come to a guy come to your house and put your groceries away, would you want, would it be weird or would you do that? Would you have that service? Like, not just
I
drop
would
it off
not.
in the front, like come in and put it on your shelves. That's the key part for me.
Well, I can still do it myself. But, if I was older, and, I couldn't get around so much and, I couldn't lift those heavy boxes, yeah, maybe I would have that done.
Fair point. But here, in the USA, we tip everybody, and so that's one more thing. You got to have some cash on hand to tip that guy. But yeah, I think you're right. There's really nothing wrong with it. It makes sense. Just as an American, it's labor. Things are cheap here, and labor is expensive, and so that's kind of the mindset. Whereas in Asia, it's typically flipped. It just sounds like a. I'm surprised people are doing it, but they're doing it. We have a few questions. Listen to Warren Buffett. BTC is trash. All right. Any recording of this session? Thank you for that compliment. Baby boomers won't understand BTC. I don't know if he means us, Owen. We're technically Gen X, but I think
No, I think
Owen.
he means Bitcoin.
Yeah, yeah. Maybe I think he's referring to other baby boomers, not to us as Gen Xers. Uh, the Beauty of Options asks, what's the impact of the Fed's decision on Halo assets, positive or negative? I'm assuming that means an upcoming Fed decision, like the Fed's potential rate cuts. Yeah, do you have an answer to that?
Well, if the Fed has to raise interest rates, that is negative for the Halo stocks. One of the reasons why a lot of those dividend aristocrat companies did not do well when interest rates were high is because the treasury yield was outcompeting the yield that they offer from their dividend. So if yields go up, that's actually not good for these companies. If yields go down, if we have real recession risk and rates have to go down because credit would beat inflation in the minds of the Fed, well, then that would be beneficial for these companies.
Yep. And a lot of them, not all, but a lot of them just borrow a lot of money. So if rates go up, and it's maybe some that's locked in, but they'll be refinancing at higher rates too, which is a ding. Okay, how to choose Halo Core ETFs? Speaking of ETFs, XLE, XLU, XLI, IFR, APAVE. Just speaking quickly, I don't know the holdings of each of these. Some of them I do, and I wouldn't pile into an energy ETF or pure utilities ETF thinking it's Halo. I think that's those are going to be pricier for the AI theme, like Owen mentioned, for the same reason Eaton and Caterpillar are pricey. Um, any strong thoughts on this, Owen, or not?
Well, I think that the easiest one is NOBL, and that's the S&P 500 Dividend Aristocrats ETF. So those are companies that have been raising their dividend for the last 25 consecutive years at a minimum. And in there, you're going to get companies like Sherwin-Williams, you're going to get McDonald's, Coca-Cola, ExxonMobil. They're all dividend aristocrats.
Yep, good answer. Good answer. Thanks, Owen. Um, Okay, one last question, then we'll move on. Do we expect the Fed to maintain their rate cut plans given the onset of the Iran war, or would be surprised by a rate hike instead? We talked about that. Owen talked about that a bit. I think my guess is a rate hike is probably unlikely unless things get really crazy. But I would not be surprised, and I don't have it in this presentation, but the market there's about a 25% probability of no rate cuts for the rest of this year now, whereas previously I think the main bet was for 2 rate cuts. So with war-driven inflation, the odds of a rate cut have certainly gone down. I think that's fair to say. I wouldn't put money on a rate hike, but it's unpredictable. Nobody knows, not even the Fed. So, all right, let me just move us along. I know we got a few more questions. Thanks for the question, guys. We love you for asking these questions. The inverse of Halo SaaS, too beaten down? Well, this graph is going to be also hard to see. This is from Yahoo Finance. If you're on a mobile, the shaded chart, This is year to date. This is a IGV, software focused ETF that has a lot of SaaS stocks, down 20.3% versus at the time I took the screenshot, the S&P 500, which is kind of this thin, I guess, also bluish line, at the top was just down 3.1%. So by roughly 17 percentage points, this software ETF is underperforming the S&P. The big risk is AI disruption fears. Can companies just vibe code their way to software? And if so, is that going to kill SaaS stocks? That's what the market, at least part of the market, is saying with this price movement. Personally, I disagree. Okay, you can have a different view if you're watching and you think otherwise, but I don't think AI is that good. I think it's pretty good. And as I said on a recent video, it's kind of like AI is a big autofill. LLMs work like a big autofill. If you're typing a text or typing a Word document, it predicts what's going to come next based on what you've been saying. AI does average writing immediately, which is a miracle. It's cool. AI does not do good writing. Same thing with software. I'm not a coder, so I can't speak chapter and verse on this, but if AI can code 99% of your software, but there's a 1% error rate, yeah, maybe a person can fix, and certainly it's going to be more efficient. But to do it that way, it's hard for me to see AI replacing, especially vertically integrated software quickly. In fact, some of these companies may benefit from using AI. And look at this. These are generally down between 25 and 50%. Adobe down 25%, normally 40 times earnings, now 16 times. Salesforce down 24%, even though they're raising guidance. ServiceNow down 23%. Subscription revenue was up 20% in the past quarter. Atlassian, that's the one the market thinks is going to be most affected of this group by vibe coding, down 51% year to date. Customer retention, though, is still pretty good. HubSpot down 31%, still has good customer retention. That's kind of like a content sales platform for usually smaller, medium businesses. And Workday, which sells to big, mature companies, and a whole lot of them. Finance software, HR software down 35%. I have not drilled down into each one of these, but I can tell you, I'm looking to invest in SaaS right now. I think we're having an overreaction. I think these are legitimate good companies, and the market is throwing them all out as babies with the bathwater. That's my personal view. Oh, and I don't know if you have a view on this, but I think just as Halo, to a greater extent than Halo may be overpriced, SaaS is temporarily underpriced.
Well, I would say I'm actually much more impressed by artificial intelligence than you seem to be. I do think that it is going to take over a big proportion of coding. I really think that what you're seeing in software as a service like now is very similar to what happened to banks in 2008. And that was a crash. And everyone was worried about the end of finance and that we were going to have a global depression. And what happened was some of those banks did go bust, and others went into almost 10 years of doing nothing at all. They had a huge decline. It went sideways for a long time. And then there were banking stocks that bottomed in 2008, and they were at new highs by the beginning of, or really the middle of 2009. And they went on to be the best performing financial stocks for the next decade. And I think that's exactly what's going to happen with software as a service. Some of these companies are going to go bust. There is no question of that. They're not in a position where they can really absorb the threat from AI. Some will survive and barely survive, and then others will thrive. And it is momentum driven performance at this exact point in the market will give us the real indication of who are the winners from the SaaS apocalypse. Because if a company is doing well now, then that is a really strong vote of confidence that their business really does have something that is insulated from the AI onslaught. And that's a valuable characteristic after a big drawdown like we've had right now.
Excellent point, Owen. Is this stock pickers market in SaaS? Some will die, some won't. You said if the company's doing well now, that could indicate good things. Doing well meaning operations, and so
Well,
it's
no, I mean the
kind of
stock price.
the
I
stock price.
really
Okay,
mean
so
that
you think that's
if
the
the
truth?
price is
Okay,
going up, then that means that investors want it and are stepping in to buy the dip.
not many prices are going up right now. Not many prices going up. So
Well, some of
seems
them
like
are.
seems like the market. Seems like our chatters agree with you, Owen. You're a little more bullish on AI than I am. Abigut thinks I should try Claude and Grok writing. I will try it, Abigut. I just haven't been impressed so far. I'm just being honest. For certain things you don't need high end writing for, I think it's fine. If you're really trying to build that rapport with someone over text, I like to do it myself, but
I
old
really
fashioned.
think, James, that I totally agree with Abby. That if you use the paid version, the writing is excellent.
I'll try it. I'll try it. I've had other friends try to convince me of this and show me examples. Maybe it's just me. Maybe I'm biased. I can be honest. Um, Coca-Cola or Pepsi, are they Halo?
Yes, they
Someone
are.
else asked. Yeah, kind of, I think, yeah. Um, all right, let me see what other questions we got. We got a lot of questions, actually. Any thoughts on drone manufacturers or even uranium counters? Uranium? Um, oh, and we were talking before we started recording about drones, about the difference between, I mean, on paper, it's great, right? But it's actually hard to find a good one. That's your view in a nutshell?
I think there are an increasingly large number of drone companies, and they're not really performing. That's my main issue. I've seen a lot of talk about these sort of laser cannon kind of anti-drone weapons, and the the companies that are designing and building them, they're some of the largest of in the world in terms of the defense contractors, but the prices are not going up. So I wonder whether they actually work. But I think the drones themselves, the whole point is that they're cheap to manufacture and that it's a volume business. So that is going to be beneficial for the sort of the mass producing companies.
Interesting. Yeah. So probably even more of a stock pickers market than SaaS names if we go into drones. I mean, you really got to pick the right company. Okay, one more question, and then we'll take some more questions later. I just want to make sure we get through this presentation. So, are you both of the view that tech was oversold back in February, despite mostly positive Q4, excuse me, 25 earnings reports? Would you consider it a buy right now, or wait for further pullbacks in tech? So, this person is asking about tech. This is HCIRDLA, tech writ large. Do you think it's oversold right now?
I think software is definitely oversold. No question of that. You know, uh, I think you've got companies that are really paying for all of the AI build out, and they're doing it with debt right now. So usually that is when their stocks don't perform as well if they're funding their growth with debt. So I
Yeah,
think looking at idiosyncratic kind of events is probably the better way our stock pickers market is the way we're going right now.
think so too. Steady Investor says AI will be uh, good 5 to 10 years. It need another 5 to 10 years to get really good. Probably, so perhaps. I mean, I'm not a guru. I don't know enough, but that makes sense. Steady investor. Thanks for your comments. Emerging markets. I took out a chart showing that in general they've done very well, but from 2010 to 2025, they didn't. Okay, that was a period of dollar strength. In this chart, you can see EMs are the shaded blue area, down 6.5% compared to just 3% from the market year to date. The thin line is the S&P 500, so not nearly as punished as SaaS stocks, but still punished somewhat. And the reason, this is a chart courtesy of one Owen Tracy. If you look back, and this is from, looks like around 1970 to the late 60s to present, this is showing, and apologies if you're looking on a mobile, and this is, the lines are very thin. There's a thin yellow line, which is DXY, that's the US dollar index. And then there's a blue line, which is an emerging market index. and it's
No, no, wait.
almost
The blue line is the performance of the emerging markets relative to the US.
okay, relative index. Okay, relative, and yeah, that's the more relevant factor. Relative to the S&P 500.
Relative, it's MSCI USA and
Okay.
ex-US.
Got it. Got it. Okay. So relative to American stocks, basically. Um, so you can, I mean, if you're looking for the point is if you're looking for a single variable that explains a large portion of emerging market performance, it's the strength of the US dollar. And as we showed earlier, the US dollar has gotten stronger since this war or conflict in Iran began on February 28th. Hence, emerging markets have gone down. The US dollar was weakening prior, and we had about, I don't know, 15 months or so of emerging markets beating US stocks or the US stock market. So part of that is because emerging markets price their debt generally in US dollars. Lenders don't trust their volatile currencies, and emerging markets buy oil in, guess what? US dollars. So it gets more expensive for them as the US dollar rises. With all this said, though, Owen, this is explanatory. If we shift to the predictive, do you think this is a buying opportunity for emerging markets?
I really don't like the way that MSCI does the emerging market definition because one of the reasons why the kind of emerging market basket did so well is because South Korea and Taiwan are still considered emerging markets, and they're massive AI plays. The South Korean market has doubled in a very short period of time. So a lot of that had to do with the performance of emerging markets. That's why I prefer to look at the US ex US, because it's not just the USA that are it's not just emerging markets. It's Europe, it's Japan. Everything does better when the dollar is going down. So the dollar strength right now, I really think is temporary. And when we get out of this short-term crisis, it's going to start going down again. And that is when I think we're going to see a lot more buying. I would say the one emerging market that is most affected by the jump in oil prices and the strength in the dollar is India. India's stock market is going down every day because of this issue. And when it starts to turn around, when oil prices start coming back down in a meaningful manner, I think India's market is going to go up and go up in a very big way.
I was flipping through. I thought I had it in the appendix, but I must have deleted it. I had a slide showing emerging market performance over the past year, and yeah, South Korea has more than doubled. Really amazing. India, not as much, but and Taiwan is up. It's really emerging market is too big of a moniker. Totally agree with you. South Korea has emerged. Taiwan has emerged. They're not really emerging markets. They used to be a long time ago. So it really depends on what emerging market you're talking about. Another stock pickers market. So it sounds like, at least for some of the emerging markets, though, you might be a buyer. India,
Not
uh,
yet, but definitely watch.
not yet. All right. Speaking of being a buyer, oh, okay, great insight. Thank you very much for these kind, good points. We're getting some praise, Owen. Probably mostly to Owen, but thank you for all this. Um, Constellation Software is a share that I am watching. Again, these are not recommendations. These are just stocks we're looking at. You got to start somewhere, okay? And if you were starting with Constellation Software, I would start with the chart on the lower right-hand corner of this screen. This is a 5-year chart. It's hard to read the numbers, up just 34% over the past 5 years because, as you can see, kind of near the middle to end of 2025, as this AI killing software theme really caught on, Constellation Software went way down. The top chart is the past 6 months. This stock is down almost 42% over the past 6 months. So if you're a momentum investor, you would be running away from this share, not towards it. Uh, Trades in Canada and also over the counter in the U.S. This is arguably one of the best acquirers in the world. It was started in 1995 by a guy named Mark Leonard, a former venture capitalist, and they are. It's kind of like a Berkshire Hathaway for software. It's got some of the same cult following people who go to the Berkshire Hathaway meeting every year. I'm one of them, by the way. They all like Constellation Software because it's very good well-run business, focus on quality, vertically integrated software. These are software systems that are working at multiple points in a company's value chain. Uh, I am not a developer, but I believe this is the hardest area of software to rip out of a company because it touches so many parts and it kind of compounds on itself. So arguably, this is going to be less affected by the SaaS apocalypse in terms of actual earnings than some of the others. Uh, 55% off its all-time high. Normally, it's at a PE of a price to free cash flow, excuse me, of 15. But now it is at 15. Normally, it's 30 to 40. So it's substantially cheaper than it normally trades at. 73% of its revenue is recurring. Analysts are expecting 67% upside. These are Wall Street analyst consensus. I'd say at least that, in my view. In my view, it may not happen. Okay, my own just prediction. Mark Leonard, this guy on the right, left his CEO role in September, I believe it was last year, due to health concerns. He is still on the board, but that kind of shook people off. You got a kind of a charismatic founder, but net income is still, was dinged, but it was not related to operations. It was more foreign exchange, revaluation. When you have a company that does a lot of acquisitions, the accounting is wonky. And sometimes you can't trust the GAAP or the IFRS numbers as much as you would with a more regular company. But in general, I think quality is oversold right now. I think SaaS is oversold right now. And Constellation software fits into both of those buckets. It is the stock that I'm watching. Uh, with that said, that's mine. Owen, I believe yours is a Singaporean share.
Well, I thought, that since we're talking to Singapore clients, that it would be important to also look at the domestic market. And Wilmar is the one that I think is particularly interesting because uh, it's not just oil that comes out of the Middle East. It's also going to be a lot of fertilizer. And that is an agricultural play. So we've seen a jump in agriculture, we've seen a jump in fertilizers, but then you're also going to see alternatives because we are looking at a loss of a minimum of 10 million barrels a day of oil as long as this lasts. And that is not going to be easily replaced. And it's going to create a significant supply problem. And that means that you need alternatives. And there's going to be a jump in demand for wind. There's going to be a jump in demand for solar. But there's also going to be a jump in demand for biodiesel. And that is something that Wilmar will also produce. So I think you're getting two different themes here. You're getting demand for agriculture and demand for fertilizers. You're getting demand for palm oil. And the bigger challenge is that a lot of these companies that rely on expanding their agricultural base have been under a cloud for the last decade because of environmental lobbies talking about that it's the wrong thing to do to cut down trees so that you can plant. So these shares have massively underperformed. And now, with higher energy prices, a lot of those sort of environmental concerns, they don't go away, but they get put to the side. And that's when these kinds of shares start to perform. And it is really just breaking out of a very long downtrend. So I think that Wilmar has a long way to go on the upside.
And I found this picture of palm oil. By the way, I found all my pictures, they're public domain pictures in this slide deck. I'm proud of that. It looks kind of like hot pot oil, actually, like if you were in Chengdu or somewhere, kind of interesting. And I think that the environmental complaint, yes, they're chopping down jungle, which is very biodiverse, to plant basically monoculture palm trees. But we need it, and so it's kind of a trade off, right? I found a few stats here on this. Doing pretty strong operationally. Turnover revenue is up, profits are up, and you're right. If there's a choke on fertilizer from the Middle East, this company should do well.
Well, it's a little bit like in Wilmar's case, it's a little bit like Eminem. They've settled all their lawsuits. So now that they have paid back everybody, they're in a strong position to benefit now.
Absolutely, good stock. So let's take questions in a second. I got a few more here, and then we'll actually before that let's go over the trivia. But before the trivia, Nasdaq is up now. VIX also down. Owen, great analysis. Someone says whoever invested in local palm oil companies last year has been rewarded very, very generously today. Palm oil. How about someone else says the steady investor? How about oil tech, China aviation? Um, I don't have a strong thought on oil tech or China aviation. I don't know if you do, Owen. It's not my area of expertise, but certainly people are interested.
Well, I think if you're talking about oil tech, is that really going to be more about the AI drilling, and that is really what I think the USA is betting on. I think ultimately China will have an aeronautics industry comparable to Europe and the USA, and I think that's one of the biggest challenges for a company like Boeing, which is one of the worst managed companies out there.
Yeah, they've had a rough go of it for sure. Okay, so before we take any further questions from the audience, let me go back to those three questions I asked at the top, because if you're watching this, you may want some Tiger merchandise. Off the top of my head, the first question was, what is the drone maker that James, that I was interested, drone maker and anti-drone technology company that I was interested in researching further? So again, what's the drone maker that I talked about during this presentation? I don't know if it's the first person who answer, but whoever answers this, you get one of the prizes. The second question, if you recall, was what percentage of US stocks have contributed all the returns of the US stock market over roughly the past 100 years? Again, one more time, what percentage, and I shared this kind of early on, what percentage of US stocks have contributed essentially all the gains of the US stock market over roughly the past 100 years? I think it was December 1923 to December 1925 to, excuse me, December 2023. So 98 years, almost 100 years. And the third question, and you should easily know this one, what type of oil is most key to Owen's investment thesis? What type of oil is most key to the investment idea that Owen shared? So answer those, I believe, in the chat. I can't see the chat anymore, maybe so people can't give away the answers. And I can't see any more questions, but if you do have any more questions, I can check my WeChat and see what may come of it. So all right, maybe we're good. Maybe we answered all the questions. We'll hold tight for a minute just in case anything else comes on. But Owen, I had a lot of fun doing this, and I hope you did too. And most importantly, I hope you guys watching at home or in the subway or at someone else's house at work, wherever you're watching this, I hope you guys had a good time also. It's a lot of fun to get questions from the audience. We love it very much. We like when you care. We're doing this for you. So thank you for all those good insights, the compliments, the questions. Perhaps we can do this again sometime. It's been fun. So with that said, if we have no further questions, guys, remember, it's fun to invest based on catalysts. Sometimes you can make money, but there's also nothing wrong with buying an index fund or buying some long-term share and just holding, especially if you're newer to investing, uh, be a little on the cautious side, especially in uncertain times. Oh, and I don't know if you, those are my final words of advice. I don't know if you have anything to share with the audience as well from your perspective.
I think I love investing with catalysts, and I really like momentum. And I think the most important thing is to remember that a catalyst and a high momentum, it's very rewarding very, very quickly. And the most important thing to remind yourself of is that the momentum trades don't last forever. And when they turn, they can turn very violently. So the most important thing when you're investing is money control discipline. And it's always best to think about what can go wrong before you invest, because it's a lot more difficult thinking about it afterwards.
Yep. So true. So true. What's your outlook on China? Somebody asked very quickly. Oh no, oil tech stock market. Maybe you didn't ask that. So anyway, so guys, save your questions. If we do another one, how about silver? 30-second answer on silver. Owen, do you have a view on that?
Silver is consolidating. I think $70 is the low.
Okay. Quick outlook on China. Another quick question.
Um, I like the H share index in Hong Kong rather than the mainland market.
Yeah, I concur with that. I think there's more risk in China than is priced in right now. What's your view about the market in the next 6 months? I would say flat. My own view, flat to next 6 months. I'm more positive after that. What about you, Owen?
I think 6 months will be a new highs.
New high. Okay, so Owen is more bullish than I am. Um, all right, guys. Thanks for the questions. I think that's it. Happy to do this. Really appreciate your watching and hope to see you guys again in the future.